Right now, there are active military conflicts in Ukraine, the Middle East, Venezuela, and multiple flashpoints in the South China Sea. NATO just committed to spending 5% of GDP on defense by 2035. The United States Congress approved $900 billion in defense spending for 2026 alone. And JPMorgan's own Center for Geopolitics is telling its largest clients, this is one of the most uncertain and turbulent geopolitical periods in our lifetimes. Here is what most investors are doing with that information. Nothing. They are watching the news, feeling anxious, and leaving their portfolios unchanged. Here is what the data says about that decision. The S&P 500 Aerospace and Defense Index gained over 53% in the past 12 months. The broad S&P 500 gained 16%. The gap between investors who repositioned and those who did not is already enormous, and 2026 has barely started. Before this video ends, I will tell you the one asset class that has gained during every major armed conflict of the last 100 years. But first, 6 specific moves, real ETF tickers, and exactly what Goldman Sachs, Morgan Stanley, JPMorgan, and Bank of America are telling their biggest clients right now. Morgan Stanley expects the bull market to continue into a fourth year, projecting near double-digit S&P 500 returns with a target around 7,500. Goldman Sachs remains constructive, forecasting earnings growth broadening beyond mega-cap technology. Bank of America's chief investment officer calls this an owl market, cautious investors sitting on significant sideline cash that, when deployed, becomes a powerful tailwind. But the honest picture has real risks. The 10 largest S&P 500 stocks represent approximately 40% of the entire index, concentration that leaves almost no margin for error if earnings disappoint. Allianz Global Investors forecasts inflation averaging above 3% in 2026, constraining Fed flexibility. Wellington management is direct. 2026 will be a long way from Goldilocks. Prudent investors should position for higher inflation, slower growth, and more volatility than the past 3 years produced. If you want investing content built on what institutions are actually doing, not what headlines are screaming, subscribe. One video every week, all sourced data. JPMorgan's Center for Geopolitics identifies 3 defining themes for 2026: fierce competition between great powers, war, and hopefully peace, and uncertainty from the United States itself. Wellington management frames this with critical historical context. Geopolitical cycles last between 80 and 100 years. The structural shifts underway now, national security prioritization, supply chain fragmentation, and US-China great power competition, come around once per century. This is a regime change, and regime changes punish investors who assume what worked in the last regime keeps working in the next one. Bank of America's senior investment strategist has named what is happening a security supercycle, spanning traditional aerospace and defense, cybersecurity, drones, AI-driven military technology, and satellite networks. Global defense spending is projected to top $3.6 trillion by 2030, a 33% rise from 2024 levels, according to Global X. The U.S. Congress has already approved $900 billion for 2026 alone. That capital flows directly into publicly traded companies. The question is whether your portfolio captures any of it. Move 1. Defense sector ETFs. The Aerospace and Defense Index outperformed the broad market by 37 percentage points in the past year. For large cap stability, ITA, the iShares US Aerospace and Defense ETF, holds $15 billion in assets at a 0.38% expense ratio. For broader mid and small cap defense exposure, XAR, the SPDRS and P Aerospace and Defense ETF, carries a lower expense ratio of 0.35% and includes drone and next-generation defense names. For technology-forward exposure covering cybersecurity and AI military applications, SHLD, the Global X Defense Tech ETF, targets where defense spending is heading, not just where it is now. Move 2. Gold as your geopolitical hedge. Here is the open loop I planted at the start. The one asset class that has gained during every major armed conflict of the last 100 years is gold. World War I, World War II, Korea, Vietnam, Gulf War, post 9/11. In every case, gold preserved or increased purchasing power, while other assets collapsed. Gold hit record highs in January 2026 as geopolitical tensions escalated. GLD, the SPDR Gold Trust, gained nearly 6% in the opening weeks of the year alone. This is not speculation. It is insurance. A 5 to 10% allocation to GLD or IAU, the iShares Gold Trust, at 0.25% expense ratio, is what multiple institutional advisors recommend specifically for this environment. Move 3. International diversification. Goldman Sachs projects the dollar continuing to weaken in 2026 as demand for U.S. assets diminishes. A weaker dollar makes international stocks worth more in dollar terms, a currency tailwind compounding on top of local earnings growth. Allianz and Goldman Sachs both flag European equities as more attractively priced than U.S. counterparts. VEA, the Vanguard FTSE, Developed Markets ETF, provides broad Europe and Asia-Pacific exposure at just 0.06%. For targeted European defense exposure, EUAD, the Select Stocks Europe Aerospace and Defense ETF, adds the fiscal expansion tailwind. Move 4. Energy and critical materials. Energy is no longer just an economic asset. Wellington management is explicit. Natural gas, grid infrastructure, and critical minerals are now national security assets. For broad energy exposure, XLE, the Energy Select Sector SPDR ETF, captures major producers with strong free cash flow. For copper specifically, essential simultaneously for EV infrastructure, AI data centers, and military hardware. COPX, the Global X Copper Miners ETF, targets a supply-constrained commodity facing multi-source demand growth that Wellington flags as one of the most compelling structural positions of this decade. Move 5. Build income before volatility hits. Morgan Stanley recommends maximum asset class diversification and active risk management for 2026. Owning income means collecting returns through turbulence, reinvesting at lower prices, and recovering faster. VIG, the Vanguard Dividend Appreciation ETF, provides exposure to companies with consistent dividend growth and strong balance sheets. BND, the Vanguard Total Bond Market ETF, adds fixed income ballast. In a geopolitically elevated environment, income is not a conservative choice. It is a risk management tool. Move 6. Max tax advantaged accounts first. Before adding a single dollar into any of these ETFs in a taxable account, maximize your tax-advantaged contributions. The 2026 401k limit is $23,500. The IRA limit is $7,000 to $8,000 if you are 50 or older. An HSA adds $4,150 with triple tax advantage. Your employer 401k match is a 100% guaranteed instant return. No ETF beats that math. Do this first, every year, before anything else. 3 risks to understand before making any of these moves. First, valuation. Even with strong earnings forecasts, the market's price-to-earnings ratio leaves minimal margin for error. Any disappointment reprices everything lower, regardless of the geopolitical backdrop. Second, defense stock timing. The motley fool is explicit. The worst time to buy defense stocks is when conflicts dominate headlines and shares are spiking. After a 53% run, you are buying momentum, not value. Patience is required. Third, inflation persistence. Allianz forecasts above 3% average inflation in 2026 with upside risk from tariffs, which limits Fed flexibility and erodes real returns. These are not reasons to stay in cash. They are reasons to be diversified, income-generating, and hedged alongside your growth exposure. I promised you the one asset class that has gained in every major armed conflict of the last 100 years. That is gold, GLD or IAU, 5 to 10% of your portfolio. Not speculation, insurance. That is move 2. And if you do only one thing from this video, that is the move that directly addresses what every headline is pointing at right now. 6 moves. Defense exposure through ITA, XAR, or SHLD. Gold as your geopolitical hedge via GLD or IAU. International diversification through VEA and EUAD. Energy and critical materials through XLE and COPX. Income before volatility hits with VIG and BND, and max every tax-advantaged account before touching a taxable brokerage, because a guaranteed return beats every ETF in a risk-elevated year. That is the full playbook, built on what Goldman Sachs, Morgan Stanley, JPMorgan, Wellington, and Bank of America are actually doing. My question for the comments: which geopolitical risk worries you most as an investor right now? Ukraine, the Middle East, a US-China escalation, or something else entirely? And are you repositioning or staying the course? Drop it below. I read every response. And if this gave you a real framework instead of just anxiety, subscribe.